Dear esteemed judges and audience, my name is Siti Nordin, and I'm presenting a paper on the topic of the impact of capital market instruments on Malaysian economic growth. Before we get into the research, let me introduce the team behind this work. Beside me, there is Ms. Norizarina Ishak, Ms. Siti Raihana Hamzah, and Mr. Ahmad Nurullah Rasedee. These are the individuals who have contributed to this research, who are affiliated with the Faculty of Science and Technology and the Faculty of Economics and Muamalat at University of Sciences of Malaysia. With this introduction, let's now move on to the contents of the research. Capital markets are essential for providing funds for profitable ventures like company growth, infrastructure improvements, and research and development. A well-run capital markets with strong regulatory frameworks attract both local and foreign investments, contributing to economic growth. The efficient allocation of resources through capital markets boosts national economic growth by directing capital into productive industries. The objectives of this study are to model stock, bond, sukuk, and foreign exchange markets towards Malaysian economic growth using the autoregressive distributed lag, ARDL, both in the long and short run, and to analyze the effect of stock, bond, sukuk, and foreign exchange markets towards Malaysian economic growth both in the long and short run by employing the ARDL method. Previous research has largely focused on the individual effects of different capital market instruments. However, there is a lack of studies that examine the combined or cumulative impact of these instruments on economic growth, particularly in the Malaysian context. Our research will contribute to the existing literature by providing a comprehensive analysis of the cumulative effects of the stock, bond, sukuk, and forex market on Malaysian economic growth. To address the research gap, we collected a comprehensive dataset to analyze the cumulative effects of capital market instruments on Malaysian economic growth. This slide outlines the data collection process. We collected data from various sources over a period of 12 years from 2010 to 2022. The key variables included GDP per capita, the FBM-KLCI index, the new issuance of corporate bonds, new issuance of corporate sukuk, the MYR-USD exchange rate, and the unemployment rate. These data were obtained from reputable sources such as November Database, Yahoo Finance, Fast BNM, Investing.com, and the Department of Statistics Malaysia. To analyze the relationship between these variables, we employed the autoregressive distributed lag ARDL model. This method is suitable for analyzing the long-run and short-run relationships between variables, even when they are not stationary. Proceeding with the ARDL model estimation, it is essential to ensure that the variables are stationary. A unit root test or stationarity test is used to determine if a variable is integrated. If a variable is integrated, it has a unit root and is non-stationary. We employed the ADF augmented decay test to examine the stationarity of the variables. The lag length was selected using the Archive Key Information Criterion AIC to minimize the information loss. The null hypothesis of the stationarity test states that the variable has a unit root, while the alternative hypothesis states that the variable is stationary. This equation represents the ADF test progression. To the stationarity of the variables, we proceeded to estimate the ARDL model. The ARDL model is a versatile technique that can handle variables with different orders of integration, making it suitable for our analysis. As mentioned earlier, the stationarity test is crucial for applying the ARDL model. The ARDL model is estimated using the ordinary least square, a widely used statistical method. The ARDL model can identify long-run equilibrium relationships between the variables through co-integration analysis. Additionally, the ARDL model includes an error correction mechanism that captures how the variable adjusts in the short run to reach the long-run equilibrium. Represents the ARDL model, where yt is the dependent variable and x1t, x2t, and xkt are the independent variables. Alpha 0 is the intercept, constant term. Alpha I are the coefficients of the laggard values of y, with p being the maximum lag order of the dependent variable. Estimating the ARDL model, it is crucial to conduct diagnostic tests to ensure the validity of our results. The serial correlation Lagrange multiplier test is used to check for any autocorrelation in the residuals. The Bush-Pagan-Gottfried test and the autoregressive conditional heteroskedasticity test are employed to detect heteroskedasticity, which occurs when the variance of the residuals is not constant over time. Ramsey's reset test is used to identify any misspecification of the model, such as the omission of relevant variables or incorrect functional form. The Jack-Bera normality test checks if the residuals follow a normal distribution. Custom and custom of squared tests are used to examine the stability of the model over time, looking for any changes in the relationship between the variables or in the variance of the residuals. We conducted multiple diagnostic tests to ensure the robustness of our findings. By using a combination of tests, we can increase our confidence in the validity of the model and its result. Tests such as custom and custom of squared tests are particularly important for time series data to detect any structural changes in the model over time. Having conducted these diagnostic tests, we can now discuss the results and assess the overall validity of our ARDL model in the next chapter. To get a better understanding of the data and identify any potential trends or patterns, we first conducted descriptive statistical analysis. The average GDP per capita at current price recorded is 314 to 39.93 million, ranging from the lowest of 196,650 million to the highest of 467,305.7 million. High rate of unemployment was recorded in Q1 2020, as much as 5.10%. This can be concluded as the effect of lockdowns occurring during the pandemic COVID-19, where economical activities are limited. The new issuance of corporate bond and new issuance of corporate sukuk recorded distinct value of mean and median, with corporate bond of 1.53 billion and 1.07 billion respectively, and corporate sukuk of 1.16 billion and 0.684 billion respectively, indicating presence of outliers supported by the high value of KOSIST. The skewness of FTSE Bursa Malaysia KLCI Index and the exchange rate of Malaysian ringgit to US dollar with negative 0.03 and negative 0.26 respectively, suggesting left skew distribution, indicating there are more negative returns compared to positive returns for stock market, and that Malaysian ringgit faced frequent depreciates in value during Q1 2010 to Q4 2022. A kurtosis of 12.07 per corporate bond is significantly greater than 3, indicating a leptokotic distribution. This shows that the data are more likely to contain extreme values or potential outliers compared to a normal distribution. Nevertheless, international crises such as 2008 financial crisis or the COVID-19 pandemic can trigger sudden and large-scale changes in bond markets. Econometrics. Strong positive correlations between loan GDP per capita at current price and loan MYR/USD with 0.8784, loan unemployment and loan MYR/USD with 0.6235, loan GDP per capita and loan unemployment with 0.5805, implying that the higher value of Malaysian ringgit relative to the US dollar strongly related to the higher GDP per capita at current price and higher unemployment rate, while increase in GDP per capita is moderately related to higher unemployment rate. Loan FBM KLCI index and the loan unemployment shows the highest negative correlation of negative 0.41x7, fairly close to negative 1, implying where peak performance of stock market may relate to lower unemployment rate. Next is the result of the stationarity test conducted. I and INT are the specification of the ARDL, with intercept and trend respectively. All variables are found to be integrated at the combination of both I0 and I1. Loan corporate bond and loan corporate sukuk are stationary at I0 with negative 8.8322 and negative 3.2451 respectively. Loan GDP per capita, loan unemployment, loan FBM KLCI index, and loan MYR/USD are stationary at I1 with negative 6.072, negative 6.3444, negative 9.1996, and negative 5.9155 respectively. This is the ARDL model specification. Natural logarithm is applied to put all data on comparable values for the purpose of linearity, producing ln GDP per capita at current price at time t equals to theta 1 plus theta 2 ln FVM KSCI index at time t plus theta 3 ln corporate bond at time t plus theta 4 ln corporate suku at time t plus theta 5 ln MYR USD at time t plus theta 6 ln unemployment at time t plus mu t, the error term. Co-integration and bound test is employed as this study is working with variables that are integrated in orders I0 and I1. The hypothesis for this test is no levels relationship between the dependent variable and independent variables in the model. No level relationship meaning there's no integration between the dependent and independent variables. The results show that the value of F statistics 6.4202 is evidently higher than the upper bound 4.9810 and simultaneously higher than the lower critical bound 3.5930. Therefore, the F-stats is more than critical values. The H-null is rejected, implying that there is co-integration between the dependent variables and the independent variables in the long run, or in other words, there is a relationship between the dependent variable and independent variable in the long run. For estimation for the long run, ln FVM KSCI index and ln MYR USD are coming out with positively sized coefficients similar to reference 64 and reference 75 with 0.1579 and 0.9036 respectively. Only ln MYR USD are statistically significant with 3.6602 at 1% significance level. The negatively sized coefficient on ln corporate bond, negative 0.0832, and ln corporate sukuk, negative 0.0123, affecting ln GDP per capita at current price, resulting in contradict results from reference number 52 and reflecting result for reference 69 for corporate bond, for bond market resembling reference 43 for corporate sukuk in the long run, similar to reference number 66, and for sukuk market for both long and short run, contradict from reference number 26. Statistically insignificant in the long run. The unexpected positive sign on ln unemployment with 0.4540 and statistically significant at 10% significance level, implying that the higher unemployment rate, the higher the GDP per capita at current price. Following the results, the long-run relationships equation is ln GDP per capita at current price at time t equals to 11.7947 plus 0.9036 ln MYR USD at time t plus 0.4540 ln unemployment at time t plus mu t. Short-run form. This computes the speed at which a co-integrating relationship adjusts to long-run equilibrium, denoted as coin equation. Generally, a negative and very significant coefficient would be anticipated if variables are co-integrated. Employing the general equation of ECM, theoretically the short-run ARD equation can be written as below. In short run, ln corporate bond is 0.0048 and ln MYR USD with 0.1743 are statistically significant both at 5% significance level respectively. Ln FVM KSCI index negative 0.4813 and ln corporate sukuk with negative 0.0024 negatively impact the ln GDP per capita at current price, where ln FVM KSCI index is statistically significant at 1% significance level, while ln corporate sukuk is statistically insignificant. Ln unemployment, on the other hand, does not reflecting the result as in the long-run estimation with negative 0.4598 and is statistically significant in the short run at 1% significance level, implying that the higher the unemployment rate, the lower the GDP per capita at current price. In EQ, the error correction coefficient for model 1 is statistically significant at 1% level with negative 0.1969, hinting at the 19.69% speed of adjustment to equilibrium of the co-integrating relationship. Relationships equation is delta ln GDP per capita at current price equals to 2.2748 minus submission of 0.4813 delta ln FVM KSCI index plus submission of 0.0116 delta loan corporate bond plus submission of 0.1743 delta loan MYR USD minus submission of 0.4598 loan delta loan unemployment plus mu T. Represents the results of the diagnostic tests. A lambda test with p-value of 0.0029 is less than 0.05. Thus, we reject the null hypothesis of non-serial correlation. This indicates evidence of serial correlation in the residuals, implying that the presence of serial correlation might be a concern and could potentially affect the model's reliability. PG test, ARC test, JB test, and reset test resulting in p-value greater than 0.05. We fail to reject the null hypothesis. Thus, this shows that the model appears to be well specified with no significant evidence of serial correlation, heteroscedasticity, or misspecification. The plots of cumulative sum and cumulative sum of squares of the recursive residual test for model 1 remain between the upper and lower of 5% critical bounds, the red lines. This suggests that there is no evidence of structural instability in the model, which indicates that the model's parameters remain stable over time. In conclusion, unemployment rate and the exchange rate of Malaysian ringgit and US dollar positively impacting the economic growth and are statistically significant in the long run, while in the short run, the stock market performance, the corporate bonds new issuance, Malaysian ringgit and US dollar exchange rate, and unemployment rate are statistically significant to promote economic growth. Stock market performance and unemployment rate negatively affecting the economic growth, while corporate bonds issuance and Malaysian ringgit and US dollar exchange rate positively affecting it. Capital market instruments does show its significant impact on Malaysian economic growth, with foreign exchange market mainly driving the capital market's impact in promoting Malaysian economic growth both in the long and the short run. Sukuk market found to not have any significant impact on the economic growth both in the long and the short run. That's all from me. Thank you.